All right, let's talk about something you see all the time in the corporate world, but maybe don't think about the accounting for. A company buys another, but not 100% of it. What happens to that leftover piece? That's what we're here to unpack. It's called the non-controlling interest, or NCI, and we're going to break down exactly how to account for it.
So, think about it. You control a company, but you don't own all of it. How do you account for the rest? Let's say you buy 80% of a subsidiary. You have control, no question. But that other 20%? That's the non-controlling interest. And it's not just a number. It represents actual owners with a real claim on that subsidiary's assets. Getting this right is absolutely critical if you want to show a true and fair picture of the entire group.
Okay, so here's our game plan. We'll start with the nature of NCI, what it actually is. Then, we'll hit the big one, measurement at acquisition. After that, we'll look at the consolidation worksheet mechanics, see how special transactions affect things, and finally, wrap up with reporting and disclosure.
All right, first things first. Let's define what we're actually talking about here. What is a non-controlling interest? Fundamentally, it's so much more than just a plug number on a worksheet. It's a real, legitimate claim on a business.
The key takeaway here is that NCI is equity. Simple as that. It's the slice of the subsidiary's net assets that belongs to those other owners, the ones who aren't the parent company. It's their stake, and it gets presented right there in the equity section of the parent's consolidated financials.
Okay, this next part is maybe the most important decision in this whole process. When the acquisition happens, you hit a fork in the road. You have to decide how you're going to measure the value of this NCI. IFRS 3 actually gives you two choices, and believe me, the path you take will completely change the look of your balance sheet.
So, what are the two choices? On one side, you have what's called the full goodwill method. With this one, you measure the NCI at its fair value, its market price on acquisition day. The big result here is that you recognize 100% of the goodwill, both the parent's share and the NCI's share. Then, on the other side, you've got the partial goodwill method. This one's a bit more reserved. You value the NCI at its proportionate share of the subsidiary's net assets. And, as the name suggests, you only recognize the parent's share of the goodwill.
Okay, let's make this real with an example. We'll start with the full goodwill method. Let's say P Limited acquires 80% of S Limited. To calculate the total value of this deal, you start with what P Limited paid, which is $169,600. Then, and this is the key part for this method, you add the fair value of the NCI's 20% stake, which we're told is $42,000. Add those together, and you get a total consideration of $211,600.
And what does that give us? Well, when you take that total consideration and subtract the fair value of S Limited's net assets, you're left with goodwill of $4,600. Now here's the kicker. This $4,600 isn't just the parent's goodwill, it represents the goodwill for the entire subsidiary, including the part that's technically attributable to that 20% NCI.
Okay, now let's rewind and do the exact same deal, but this time using the partial goodwill method. The calculation is totally different. Here, you only look at what the parent paid, that $169,600, and compare it to the parent's 80% share of the net assets. Do the math, and the goodwill is only $4,000. Meanwhile, the NCI is valued completely separately at its 20% share of those net assets, which comes out to $41,400.
And this chart just puts it all side by side. Look at the difference. The NCI value is different, and the total goodwill is different. This shows you that this choice isn't just some theoretical exercise for an exam. Choosing the full goodwill method literally puts more assets on your consolidated balance sheet from day one. It's a single decision that has a huge impact on the numbers you report.
Okay, so we've got the theory down, we know how to calculate the numbers, but how do we actually do this in practice? Let's get into the mechanics of the consolidation worksheet, because things have to change to make room for the NCI.
Your standard consolidation worksheet gets a bit of a makeover. To handle the NCI properly, you're going to add a couple of new columns just for them, to track their share of things. You'll also add a separate column for the parent's share. Now, one thing to note, that Business Combination Valuation Reserve, the BCVR, where you track fair value adjustments, that stays in the main adjustments column. And then, at the very bottom of the equity section, you'll see two new lines, Total Equity Parent and Total Equity NCI.
Now this is probably the single biggest mechanical change you need to remember. Think about your pre-acquisition elimination entry. You're used to getting rid of 100% of the sub's equity, right? Well, not anymore. Now you only eliminate the parent's share,
in our case 80%, against the investment account. And that 20% you leave behind, that right there becomes the starting balance for your non-controlling interest.
All right, let's layer on a little more complexity. What happens when we have special situations, like a bargain purchase, or transactions between the parent and the sub? These require some special handling. First up, a gain on a bargain purchase. This is pretty rare, but it happens. It's basically when the parent gets an amazing deal and pays less than the fair value of the net assets they're buying. We need to know how this affects our NCI calculation.
And the rule here is super straightforward. That gain, it belongs 100% to the parent. The NCI gets zero of it. And the logic makes sense, right? The NCI shareholders weren't the ones who negotiated this great deal. The parent did. So the parent gets the entire gain. The NCI's value is still calculated based on its share of the subsidiary's fair value assets, completely unaffected by the parent's bargain.
Now, intragroup transactions are a different beast. Let's say the sub sells inventory to the parent at a profit, and the parent is still holding that inventory at year-end. From the consolidated group's perspective, that profit hasn't actually been earned yet. It's unrealized. So here's the process. First, you have to adjust the subsidiary's equity to take out that unrealized profit. Then, once you have that adjusted, clean equity number, you can calculate the NCI share of it.
Okay, we've done all the hard work behind the scenes. So how does this all look in the final published financial statements? Let's talk about reporting and disclosure.
But before we look at the specific line items, let's just circle back to the fundamental idea here. What is NCI? It's an ownership interest. It gives the NCI holders a right to a share of the subsidiary's equity. But not just any equity. It's their share of the equity after we've made all our consolidations adjustments, like for fair value and those intragroup transactions.
The standards are really clear about how this needs to be shown. On the statement of profit or loss, you have to split the total profit between the owners of the parent and the NCI. Same goes for the statement of changes in equity. You need separate tracking for both groups. And on the statement of financial position, the NCI gets its very own line right there in the equity section, separate from the parent's equity.
And this isn't just good practice, it's a rule. IFRS 10 says it flat out. The NCI shall be presented within equity, separately from the equity of the owners of the parent. So there's no ambiguity, it's not a liability, it's not some weird mezzanine item, it's equity, through and through, representing that ownership stake. And it's really important to get that this isn't a set-it-and-forget-it calculation you do only at acquisition. No way. Every single period after the acquisition, you have to keep track. When the subsidiary makes a profit or a loss or pays a dividend, you have to allocate it between the parent and the NCI based on their ownership percentages. It's a continuous process of updating their respective claims. Which brings us full circle right back to that critical choice at the beginning, full goodwill or partial goodwill. It sounds like a technical detail, but as we've seen, its impact is massive. It directly changes the total goodwill and therefore the total assets reported on the balance sheet. So I'll leave you with this question. If you're an investor looking at a company, doesn't it seem pretty important to know which of these two perfectly valid methods they chose and how that one decision shapes the entire financial picture you're looking at?